Good afternoon, students. We are going to continue discussing property, plant, and equipment today. We are not going to continue with the notes that we started with on Monday. We'll continue with that next Monday when we have our joint session. So today I want to take some of those aspects that we spoke about on Monday and take them further. So we are going to look at measurement, and then we are going to look at the various depreciation methods. So that is our mission for today. So let us, I've typed a separate little document here for us as a working document for the class. So we're going to basically work our way through this, but I'm going to interchange between this little document and the question that we are going to be doing after we started discussing this document. So there are, you will just have to bear with me. I'm going to change between documents in a few minutes' time. So let us just first look at what we are going to be talking about today and what we are going to be discussing. Like we said, in a nutshell, measurement. Now, you remember on Monday we said that there's the initial measurement. In other words, how we calculate the total cost of any property, plant, and equipment that we are acquiring on the date of its acquisition. And then we've also got the matter of subsequent measurement. How do we value that item or that group of items or that category of items of property, plant, and equipment after we've acquired it? And we said on Monday that will usually be either when you drop your financial statements or when you are about to dispose of that asset, right? So now, first of all, we're going to focus on initial measurement, and then later on, we're going to talk about subsequent measurement. Subsequent measurement is where the concept of depreciation comes in. When it comes to the initial measurement, we said, ladies and gentlemen, there are basically three components to it. The third one we're only going to encounter in our second year in financial accounting 2, the certain future cost, but we must just be aware that there is a third factor. So first of all, our purchase price. That will always form part of the cost of basically any asset, but in our case now, property, plant, and equipment, right? The purchase price. And like I've mentioned on Monday, the purchase price is in essence determined by what you pay for it, right? And like I also said on Monday, it doesn't necessarily mean it has to be a cash purchase. You don't need to pay it on the date of acquisition. It could be a credit acquisition or a credit purchase where you're only going to pay the amount, let's say, in a month or in 2 months or in 3 months' time, or even in installments. That is also possible, monthly installments. But the point is what the purchase, the purchase price is what you will eventually pay for it, but it excludes something like finance charges if it's going to be paid in installments. So if you purchase it today for 100,000 rands and you're going to, or that is the price that they charge you, and you're going to pay that 100,000 rands in 2 months' time, it still means your purchase price is 100,000 rands, right? Then there is the matter of directly attributable cost. Now, the concept is exactly the same as with inventory, but we just need to refresh our memories. We need to discuss it again, and then we are going to go through an exercise on how to put this into practice, how we practically apply this. So, what is directly attributable cost? So, a directly attributable cost is a cost that is necessarily incurred. So, first of all, it's got to be a necessary cost, necessarily incurred to bring the asset to either a condition or a location. And conditions means that its status or its properties is in such a is in such a fashion that it can obviously function. Or a location, that means where it is at, where it is physically situated at any point in time. where it can be used as management intents, right? So it's a cost that is necessarily incurred to bring the asset to either a condition or a location where it can be used as management intents. Now, what management intended with inventory, you will remember that is to resell it, is to sell it to their customers. In the case of property, plant, and equipment, it will obviously be something different, but it will all depend on the kind of property, plant, and equipment. If it's, for instance, factory machinery, factory plant and machinery, then the intention of management will be to use it to produce their products, right? Or if it is a delivery vehicle that you've acquired, it means that the intention of management is to use it to transport the inventories that they've sold to customers to the customer's premises. If it's a printer copier, the intention of management is to use it for printing and to use it for copying hard copies of paper documents. Okay, ladies and gentlemen, so that is the principle on which the cost price is founded, right? So the purchase price plus the directly attributable cost. Now I'm just going to stop sharing this document, and I just want to go and open another one for us. At any time that you want to ask any questions, you are either welcome to ask it in person, or you are equally welcome to type it in the chat. Let me just go and open the other document. If I can just scroll up. Sorry, I had a financial accounting 2 class just prior to this class, and I just finished uploading that recording, so I'm still in different folders here. So let me just find that quickly. E. Okay, that's the one I'm looking for. So this is now to put it into practice. Let me just go and share it so that you can see the document. I will load it after class, ladies and gentlemen. I will load this document after class, but at this stage, we're just using it as a discussion document. So I'm just going to wait till it appears on your side. Okay, and there we are. So let us first of all, like we normally do, let us go and see what is required of us, and then we go through the question. They say here, required, calculate the total capitalized cost of the factory. If a cost should not be capitalized, in other words, if it must be written off as an expense, show a zero in the amount column on the answer sheet. Ladies and gentlemen, that last little part there is actually quite important. It sounds as if it's not important, but you could actually be allocated, and you normally will be allocated a mark for the zero, because that indicates to us that you are aware of, that you know that that cost should not be capitalized, but that it should be written off as an expense, right? So there's a good reason why you must always remember to put in a zero in a table, whether it's an online test or whether it's a written test, doesn't matter. The same principle applies. So if it must not be capitalized, you must go and put in a zero there. Okay, so let us now discuss this question. We'll read the heading there, and then we'll discuss each item individually. They say sanitized products bought a plot of land on credit on the 1st of November 2019, on which it intended to erect a factory for the manufacture of bottles of hand sanitizer, which is quite relevant in recent years, as you know, and currently still is. The following costs were incurred in connection with this project, which was completed on the 20th of August 2020. Then they give us various costs here. Some of them might have to be capitalized as part of the total cost of the asset, of that factory that they are erecting. Some not. So let us go and have a look. So, ladies and gentlemen, the first one here, purchase price of the plot of land, should that be capitalized as part of the cost of the asset or not? What would you say? You just need to type yes or no. Purchase price of the plot of land. So that is the plot of land that they are going to build or construct that factory on. What does the word purchase price indicate to you? Should it be capitalized as part of the cost of the asset of the factory, the property, plant, and equipment, which is factory in this case? Someone gonna attempt an answer there? Yes or no? Are we going to capitalize it or write that off as an expense? Capitalize, yes. Write off as an expense, no. Yes, yes, yes. Now come the answers. Thank you very much. Thank you for those answers. Yes, it is the purchase price. It's going to form part of that complete structure, which is going to consist of the land on which the factory is situated and the factory building itself, and eventually all the plant and equipment that is going to be used in the factory. So that will definitely be capitalized as part of the cost of the asset. So let us go and copy that over, and we're going to complete our answer sheet, which could be electronic or it could be paper, doesn't matter. We're going to complete it. So the purchase price of the plot of land, and that is an amount of 1,200,000. They don't tell us to take value added tax into account. So therefore, we can just, for the purpose of this particular exercise, we can ignore it. Right, so 1.2 million, that purchase price of the plot of land. Now, the next item here, they say the cost of material and labor to erect the building was 1,800,000 rands. The cost of material and labor to erect the building, 1,800,000. Now, one could actually split that up into two kinds of transactions. We don't have to. I'm just going to give you both sides of the coin here. One can either split it up, or you don't need to split it up. At the end of the day, you're going to arrive at exactly the same result. In the case of the cost of material, one can actually argue that that is purchase price. It's not the purchase price of the plot of land, but it's the purchase price of the material that is going to be used to erect the building or to construct the building. So you can figure it out that way, which then clearly means that yes, it will have to be capitalized as part of the cost of this property, plant, and equipment asset, which is going to be a factory. So that's the one way to look at it, or you can look at them in combination, the material as well as the labor. In any event, ladies and gentlemen, whichever way you take, you're going to get to the same answer. Now, the way to for this first few, we are going to go through the long process of arguing whether it qualifies as a directly attributable cost or not. And there are basically three steps that we have to take. From that definition that we had a look at a little while ago, we could identify that there are three things that need to take place or need to occur or need to be in place for this to be qualifying as a directly attributable cost. So the first question that we need to ask ourselves, is it a necessary cost or can we do without it? Is it a necessary cost? Just yes or no. Yes, thank you, Tamarin. You're quite correct. Right. Yes, thank you, Sisanda. Quite correct. It is a necessary cost, right? Because if we do not incur the material, if we do not buy the material, and if we do not incur the labor cost, then that factory is not going to erect itself, right? So without incurring the cost of the material and the cost of the labor to actually construct that building, it is impossible for that building to eventually realize. Now I'm going to ask the two subsequent questions in such a way that every time I have to ask them both. So the first thing that I'm going to ask here, does that the fact that you've bought the material and incurred the labor cost, does it play a significant role in the location of the factory? Does it change where the factory is going to be? No, thank you, Tamarin. Spot on. No, it's not changing, or it has no effect on where the factory is going to be. The factory is still going to be constructed on that particular piece of land, right? So, ladies and gentlemen, that means we have to go and ask the next question, the third and last question here. Does it play a significant role in the condition of the factory building? Yes, thank you again, Tamarin. Yes, it does. It actually makes the building come to life, or not really life, but for it to exist at all. So it doesn't need to be play a role in both the location and condition, just the one or the other. So now we've seen it is a necessary cost, and it does play a significant role, a crucial role, a fundamental role, in fact, in the condition of the building. So once again, in this case, it will have to be capitalized as part of the cost of the factory that we are erecting. So let us copy that. And we go and paste it there in our answer sheet. And the amount was 1,800,000. Okay, let us go to the third one here, ladies and gents. So here they are saying cost of transporting the materials. So that is now the materials that we've purchased, that we've bought in to use in the construction of that factory building. The cost of transporting the materials to the building site. Cost of transporting the materials to the building site. So where they are going to be erecting it. Now I've almost given it away. But again, let's go through that thought process, how we determine whether this qualifies as a directly attributable cost or not. And as you know, I'm just repeating this as a refresher. If it does qualify as a directly attributable cost, we've got to capitalize as part of the total cost of the asset. If it does not qualify as a directly attributable cost, then we write it off as an expense. So here we've got the cost of transporting the materials to the building site. So our first question is it a necessary cost? Or can we do without it? So the question is it necessary? Is it a cost that has been necessarily incurred? Or could we have done without that cost? Again, yes, 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 yes. Thank you all. Now we've got multiple answers there. Yes, it is a necessary cost. Now we've got to go further, ladies and gentlemen, and again I'm going to ask it in such a way that we've got to ask both questions. Does that cost of transporting the materials to the building site, does it play a significant role in the location of the factory itself, the location of the factory itself? And this is a tricky one. You say no, some say yes, some say no, some say yes. Okay, this is actually a tricky one. Okay, let us discuss this. It does play a significant role in where the materials are, right? So without transporting the materials to the plot of land where that factory is going to be erected, you obviously cannot build the factory, right? So it does play a significant role in where the materials are. But so there you could already have said yes. Right, so I agree you could already have said yes, but the questions are really about the asset itself. So you could also have argued, yeah, does it play a significant role in the condition of the building? And you could have argued both ways here. Either way, ladies and gentlemen, whichever way you argue, it is going to be a directly attributable cost. So you can either say because you are transporting the materials to the building site, it plays a significant role in where the factory building, where the materials are, not necessarily the factory building. But you could also argue that it plays a significant role in the condition of the factory building, because if the materials are not there, then the factory cannot be constructed. Right, so either way, it's going to be a directly attributable cost. So we can go and copy that. In the case of inventory, obviously, ladies and gentlemen, in the case of inventory, uh, where you are not using it to construct something, then it'll be the location of the inventory itself that was affected there. So then we wouldn't have even needed to ask the question, does it have an effect on the uh, condition of the inventory? But in this case, it's slightly more tricky. But at the end of the day, once again, whichever way we take the reasoning there. Oops, what did I just do? Either way that we take the reasoning there, we are going to get to the same answer, that it is a directly attributable cost. So we copy it over to our answer sheet. Now let us go to the next one. Uh, so this is now the fourth one. The cost of installing electricity in the building, 84,000 rands. The cost of installing electricity in the building. So let us go through our normal thought process here, or reasoning on how we are going to decide whether it's a directly attributable cost or not. Is it a necessary cost? We start by asking ourselves, is it a necessary cost? Or can we do without it? Yes, yes, yes. Okay, it is a necessary cost. So that already points towards a directly attributable cost, but we still got to go and ask those two subsequent questions. Now, in the case of the electricity, does it play a significant role in the location of the factory where it is? No, 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 no. Thank you for those answers. I appreciate them. Right, it doesn't play a significant role in the location of the factory, but that is not the only question. Now we've got to proceed to this last one. Does it play a significant role in the condition of the factory? Yes, thank you. Yes, yes. Okay, it does play a significant role in the condition of the factory. If the factory does not have electricity, its machinery is not going to function, and that will result in us not being able to manufacture our products, right? So, therefore, that also indicates that this is a directly attributable cost. So, let us go and copy that over. Cost of installing electricity in the building, and the amount there was 84,000 rands. Okay, now let's go to the penultimate one. The one there, they say cost of staff party to celebrate the new factory. Cost of staff party to celebrate the new factory. So let us go through our normal thought processes here. So the first question we ask ourselves is it a necessary cost? You all say no, 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 and you are all correct, right? It is not a necessary cost. We could have done without it. It is a nice to have. Everybody will be very happy that we have a social gathering and that we're having a party, and we're very happy to have this new factory because all our future is now brighter. We're probably going to get increases in our salaries and wages in the future because we are producing more products and so on. But the cost of the staff party is not necessary. So, therefore, it disqualifies it as being a directly attributable cost. So, we don't even have to go and ask the two subsequent questions. If it's not a necessary cost, can't be regarded as a directly attributable cost. So, that one we are going to write off as an expense. Let me just go back to the sheet. So, I'm going to copy there. Cost of staff party. We paste it or write it or type it in our answer sheet, and there we are going to indicate a 0. Right. Nothing is going to be capitalized. It's not going to form part of this total capitalized cost of the factory at the bottom. So that is going to be written off as an expense. Just tongue in cheek, ladies and gentlemen, just for the sake of fun. Uh, the reason why I'm doing this, in the past, some students say they were pulling my leg and they said, yes, it's an essential cost. You have to have that party, right? So let us say you are of the opinion that it is a necessary cost. Then we can then we need to go and ask the two subsequent questions. So this is just tongue in cheek. Uh, so if you consider it necessary, does it change the condition of the factory? Does it change the condition of the factory if you have that staff party? Does it make the factory itself different? How can it affect how will it affect the factory building if you have a party? Okay, so the right answer there, thank you for those answers, will be no, it's not going to it just tongue in cheek, just as in a joking fashion, ladies and gentlemen, it might change the condition of the staff, right? It might make the staff happy. It might make the staff more positive in their outlook. But this is not what the question is about. The question is about, does it play a significant role in the condition of the factory itself, the building and its uh, 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 plant and machinery that's in the building and so on. And there the answer is no. And we can now also ask the third question. Does it play a significant role in the location of the plant and machinery or the location of the factory? What would you say? Does it play a significant role, the fact that you had a party, in where that factory is situated? No, thank you. No, it has no bearing on it. It has no effect on where it is. So that also indicates that even if you mistakenly had considered that it is a necessary cost, the two subsequent questions would have disqualified that as being a directly attributable cost. Okay, so let us go to our last one there. They say the cost of advertising the products, the cost of advertising the products. Is that a directly attributable cost? So let us go through our normal process here. Cost of advertising the products. First question is it a necessary cost? Is it a necessary cost? Yes, I would agree with you. I totally agree with you. It is a necessary cost. We will now want to promote these new products that we are going to be that we are going to be manufacturing and that we are going to be marketing. And the only way, really, uh, that you are going to bring it under the attention of the consumer or the public out there is to advertise it, whether you do it by means of radio or TV ads, or by means of ads on the internet, or ads in the daily papers or magazines, or little talks on the radio or whatever. The fact is you need to promote it, so you need to advertise it, so it is a necessary cost. So that could potentially point to a directly attributable cost, but now we've got to go and ask those two subsequent questions. Does the fact that you are advertising your products play a significant role in the condition of the factory? The factory, the building, and the plant and machinery in the building. No, thank you. No, thank you. Exactly. It does not change the condition of the plant itself. The other question that we also need to ask before we can decide whether it's a directly attributable cost or not, does it play a significant role in the location of the factory? Also, no, thank you. Thank you. Tamarin, by the way, I did see your email. I've just not had time to respond to it yet. I had another class earlier and I had to do some admin around that, but I will sometime during the course of the day. Thank you. Anyway, so you all say no, so you are all correct. So again, in this case, that will be written off as advertising expense. So let me just return to the sheet. I've already copied that, so we're going to insert that. We're going to type it or write it or copy it to our answer sheet. Cost of advertising the products, and in that case, we are not going to capitalize it, so we're going to type a zero there, right? A zero. So now we've had a look at all the various kinds of costs there. So now it's just a question of determining what your total capitalized cost is by adding all of that up. If you can possibly just add that up for me and give me an answer in the chat, please. So it's going to be the 1.2 million plus 1.8 million. That gives us 3 million plus 84 plus 28,000. 84,000 plus 28,000. If I do that in my head, it looks like about 3 million 112,000. Is that right? Yes. Thank you for confirming. Thank you, Shando. 3,112,000. So let us just go and complete that. 3,112,000. Right, so there we've got our answer. Now we've got the capitalized cost of the factory. Once we are done with the factory, it is possible that if we are going to, if you are going to intend to provide depreciation on the factory building, not on the land, but the building, then then that becomes a different discussion that we'll do in financial accounting too. Okay, so we are done with this one, ladies and gentlemen. So you now know how we go about determining the initial cost on the acquisition of any property, plant, and equipment, even in this case where we are in a process of constructing that asset, right? So it's not an asset that we simply purchased and it's ready to be used. We still had to do some other actions in order to finish the construction of that total factory, the building and its contents itself. The plant and machinery will be seen as a different category of property, plant, and equipment. So when you are going to start installing them, uh, it will be a different category that you've got to capitalize the cost for, but all the same principles will apply. You're going to capitalize the purchase price of the plant and of the machinery. If you need to incur any expenses or costs to install it or to test it, to fine tune it until such time as it is correct. If you need to incur any cost to have it delivered to the factory site, all of them will be capitalized. So we're going to follow exactly the same kind of reasoning there. Okay, so let us close this one, and then let us go back to our notes for the class. Let me just find them again. And let me go and display it. Okay, so we'll just wait until it appears there on your side. There we are. Let me just move away from that and go to the chat again in case I need to see something there. Okay, so now we had a look at initial measurement, how to determine the initial cost. Now it's a question of subsequent measurement. As we've said earlier, as well as on Monday, when it comes to subsequent measurement, it means after the acquisition, after maybe a year or 6 months or 5 years since the acquisition or since the construction of that property, plant, and equipment item. How are we going to measure it when we are drawing up our financial statements or possibly when we are intending to dispose of it? This is where depreciation comes into effect, ladies and gentlemen, and we spoke about it on Monday, but I just want to refresh our memories again. So, depreciation is the systematic allocation of an asset's depreciable amount over its expected useful life, right? So, systematic is quite an important term for us. So we must design some sort of a system by which we are going to do it, and it relates to the depreciable amount. So let us just talk about the depreciable amount again. What is the depreciable amount? The depreciable amount is that amount of the cost, that initial cost that we've just calculated for that factory, for example. How much of that cost are we going to consume or use up by using that asset during the expected useful lifetime? I've typed a few examples for us down below that we are going to be discussing. So let us maybe just start with the example that we used on Monday as well. So if we are using the straight line method, and this only applies to the straight line method, if we buy an item for 100,000, we used a motor vehicle as an example on Monday, so let's use that same example just to refresh our memories. So if we are purchasing, the total cost of the asset is 100,000 rands, and we say that we are expecting to use it for 5 years, and we are also expecting that we can sell it after using it for 5 years for 60,000 rands. Then what is the value? What is that part of the cost of that asset that we are actually going to consume or use up during those 5 years? Oh, oh. Sorry, I was coughing and I've switched off my microphone. Okay, so let us restart. I'm sorry about that. So what we are saying, ladies and gentlemen, if you buy an asset for 100,000, and I'm using the same example as for the motor vehicle on Monday. Sorry about that breaking in transmission. It was a technical fault. I'm sorry. It wasn't really. I just forgot to switch on the mic after I coughed. Anyway, so if we buy a motor vehicle for 100,000 rands, and we intend to use it for 5 years, thank you for those notifications, and we expect to sell that vehicle for 60,000 rands at the end of that 5 year period. What is the value, or what is the portion in rand? What is the amount of that original cost of 100,000 rands that we are going to use up or consume over the 5 years by employing that motor vehicle in a certain activity? We bought it for 100,000. We believe we can sell it for 60,000 after 5 years, after using it for 5 years. So, what is the amount of the cost of 100,000 that we are going to use up or consume during the 5 years that we are using that asset, that motor vehicle? The difference between the two. Thank you very much. All 40,000, right? Quite correct. 40,000. So that 40,000 represents our depreciable amount. That determines the amount that we have to systematically write off over the period that we are going to use that asset, right? So now we can get a little formula for us. What is our depreciable amount? It is the cost less the residual value in the case of the straight line method. Now I'm only using this straight line method as an example. Now, when it comes to the other methods, it works slightly differently, but we are going to look at all the methods. So, ladies and gentlemen, IAS 16 depicts that we've got three methods that we may use to calculate our depreciation. In other words, to get a systematic allocation of that depreciable amount over the expected useful life. The first method is called the straight line method. The second method is called the diminishing balance method. The third method is called the usage method, also sometimes known as the sum of units method or even the sum of digits method. Now, the interesting thing is about them is that the straight line method and the diminishing balance method, both of them use time to determine your depreciation method. In the case of the usage method, that method doesn't actually use time to determine your depreciation. It uses the capacity. What that machine, this normally will relate to plant and machinery, what capacity or ability that machine has to produce products for us. Now let us go and discuss each of these methods individually. Let us start with the straight line method. Right, ladies and gentlemen, I've just come up with some very straightforward figures for us here again so that we can use them in our calculations. So we are saying doesn't matter what kind of a asset it is, but like we said the other day, let's use a motor vehicle as an example because it's one of the most commonly found uh, uh, property, plant, and equipment items. So let's say it had a cost of 1 million rands, right? So at a cost of 1 million rands, and its residual value is 100,000 rands. So we bought it and we've capitalized our directly attributable cost to a total of 1 million rands. And we believe that after we've used that for a certain period of time, which we will talk about in a few seconds, that we will be able to sell it for 100,000 rands at the end of the time that we intend to use it. Then let us also assume that this company has a financial year end every year on the 31st of December, and our first financial year end uh, is on the 31st of December 2022. Then, in the case of the straight line method, they only need to tell you what is the useful lifetime in years, right? But they could also have told you what is the useful lifetime in as a percentage. So, ladies and gentlemen, in this case where they tell us useful lifetime is 5 years, it means that we are going to write off 20% of that depreciable amount each year. And it's going to be an equal amount each year, or at least for each full financial year. When it comes to the diminishing balance method, they will have to give us a percentage, right? So let me just repeat that. In the case of the straight line method, we only need to know the useful lifetime in years. But in the case of this diminishing balance method, we also need to know the percentage that we are going to depreciate it by, and it'll become clear when we work through the example. Then they tell us there, okay, this is now not a motor vehicle. I forgot, I typed machine. So let's now say we acquired machine A on the 1st of July 2022 for 1 million rands, right? So now let us look at the straight line method. The first thing, before we can actually calculate depreciation itself, is to go, and this only applies to the straight line method and the usage method. This does not apply to the diminishing balance method. Let me put that out there up front. So when we are using the straight line method, the first thing that we've got to ask ourselves is, what is the depreciable amount? In other words, we want to calculate what is that portion of the cost that we are going to use up or consume by using that particular asset. So that will be the cost that we bought it for minus the 100,000 rands that we believe we can sell it for. So it means our depreciable amount, the value of the cost that we are going to consume or use up by using that machine A, will amount to 900,000 rands over that full 5-year period. So now, once we've calculated the depreciable amount, now we've got to go and calculate the depreciation itself. And the way we do that, ladies and gentlemen, is to take the depreciable amount, right? The depreciable amount, in other words, that 900,000, we divide it by its useful life, and that could be in months or years. We can do both examples, or both situations soon, and that gives us our annual depreciation, right? Perhaps I should just type in the annual depreciation. That gives us our the annual depreciation. But if we had not had that asset machine A available for use for a full financial year, then we'll have to go and apportion it, right? Then we have to go and apportion it. So now let's go and see what is our depreciation for the year ended the 31st of December 2022. In other words, the year during which we acquired it. And also bear in mind, we acquired it on the 1st of July 2022. So let us start with our annual depreciation, ladies and gentlemen. Let us just start there. What is our annual depreciation going to be? In other words, for every full financial year, how much are we going to write off as a depreciation expense if we are using the straight line method? The way we go about that, we take our 900,000 rands as we've seen there, which is the depreciable amount. Let's maybe just use the years initially. We divide it by 5, so that means our annual depreciation will be 180,000. Obviously, 180,000 multiplied by 5 will then give us the 900,000 rands, right? So each full financial year, we are going to write off 180,000. But for how many months during the course of this financial year did we have the use of that machine A? We bought it on the 1st of July and our financial year ends on the 31st of December. So my question is, for how many months? You can use your fingers, even I do it. How many months? 6 months. Thank you. Thank you all. Right. 100% spot on. So we had use of it for 6 months. So now we've got to go and apportion it. So therefore, we are going to take that 180,000 rands and we are going to multiply it by 6 months, the period in months that we had it available for us over the total number of months in a calendar year, which is 12. So if we take 180,000 multiplied by 6 over 12, it's obviously the same as a half. That gives us 90,000. So in our first year, we're going to write off 90,000 rands. In our second year, which will be a full financial year, we're going to write off 180,000. The year after that, we're again going to write off 180,000. The year after that, we are again going to write off 180,000 until we get to the very last financial year in which we are going to use it. In that very last financial year, we know we are only going to be using it for the first 6 months of the last year, for January, February, March, April, May, and June of the last year. So in the last year, we'll have to apportion it again. So in the very last year of us using that machine A, it will again be 6. Thank you there. Quite correct there, Kyra. Thank you. So then it'll again be for 6 months, right? But at the end of that 5-year period, it would have been for a full 60 months, for a full 5 years, in other words. Alternatively, ladies and gents, you could have used months. So then let me just see where my calculator is. You could also have said, how many months are there in 5 years? And we know that we don't need a calculator for that. We know that there are 60 months. 5 times 12 is 60. There are 60 months in a 5-year cycle or a 5-year period. So we could also have said 900,000. Now I'm just working it out on my side. 900,000 divide by 60 months. And if you can just confirm on your side, that gives me 15,000. Is that correct? Gives me 15,000. So our monthly depreciation will be 15,000 rand. So that is the other way that we could have gone about this. So we could have divided by the 5 years, which gives us an annual depreciation, or we could have divided it by 60 months, which gives us a monthly depreciation. So then we would have had 15,000 rands depreciation every month. We know that we had this machine A available for 6 months during the course of the year. So we multiplied by 6, and that then also gives us exactly the same amount, which is 90,000, right? So either way, you will get to 90,000. Let us just pause there for a short bit. Are there any questions from your side about this straight line method? It is absolutely essential that we understand how the straight line method works. Also, the diminishing balance method as well, because you're going to get questions on both of them. But when it comes to the straight line method, we keep on using that method to illustrate other other kinds of matters and issues in financial accounting too that relate to property, plant, and equipment, right? So this is quite essential. So any questions from your side? Doesn't seem to be. Okay, so now let us proceed to the next one. Oh, yeah, I just want to go display this as well, ladies and gentlemen. I almost forgot about that. So if we now look at the end of the financial year, if we now look at the end of our first financial year, the year that ended on the 31st of December 2022, what is going to be our carrying amount? What is going to be our carrying amount? And now let us just go and recap. What is the carrying amount? The carrying amount is the value that you are carrying for that asset at a particular time in your books of account. Clearly, when we are drawing up the financial statements, that it will be the value that we are carrying in our books of account at the end of the financial year when we are actually drawing up the financial statements. So, actually, don't want to display all of that yet. So, how do we calculate the carrying amount, ladies and gentlemen? We calculate the carrying amount by using the cost less the accumulated depreciation. And what does accumulated depreciation mean? It means all those depreciation expenses that you've written off so far over the useful life of that asset. So, how much? I know this is not a trick question, this is actually in front of us. So, what is the cost of the item? But I still want to see that we're all on the same page. That is why we are doing this step by step. What is the cost of machine A? 1 million rands. Thanks, Shikumbuzo. Spot on, 1 million rands. Now, why I'm asking this very often, ladies and gentlemen, students make the mistake here of now using the depreciable amount instead of the cost in calculating the carrying amount. So let me give you a warning here. Please, this is the first thing that we must now remember. When we are talking about the carrying value, then it is the cost, the initial cost, less the total accumulated depreciation. In other words, those depreciation expenses that we've written off so far in total. That gives us the carrying amount. So we don't bring the depreciable amount into this. The depreciable amount was simply to calculate the depreciation itself. Thank you, Shikumbuzu. Right, so ladies and gentlemen, so the cost is 1 million rands. What is our accumulated depreciation at the end of the 2022 year? What is our accumulated depreciation at the end of the 22 year? We've only depreciated at the end of the 22 year for the months of July, August, September, October, November, and December 2022. So thank you. It's that 90,000. Right. So it was only the initial year's depreciation. So our accumulated depreciation at the end of year one will also be 90,000 rands. So therefore, what is going to be the carrying amount for this asset, machine A, at the end of December 2022? Bearing in mind that the carrying amount or carrying value, if you wish, is the cost less the accumulated depreciation. And you see the two relevant amounts in the chat box there. 910,000. Thank you, Sikumbuzo. Thank you, Sifundu. Spot on, correct. So it'll be 910,000. Now, ladies and gentlemen, in the following year, 2023, we've already said we are going to depreciate it by a full 180,000 because it's now for a full calendar year. So, what will therefore be our accumulated depreciation at the end of 2023? Now we've got to be a little careful here, Sikumbuzu, because now we must remember in 2022, we've depreciated it by 90,000 rands, right? We've already depreciated it last year by 90,000. Now in 2023, we are going to depreciate it with another 180,000. Jodine's got it spot on there. So now, but let us just go through the reasoning. Thank you, Jodine. You've got the correct one there, correct answer. So we've already in 2022 depreciated it by 90,000, and now in 2023 we are depreciating it with a further 180,000, right? So, ladies and gentlemen, when we now talk about accumulated depreciation, it means we've got to add up all those depreciation expenses up to date as yet that we've already written off over the useful life up till the day that we are drawing up the financial statement. So it'll be the 90,000 in 2022 plus the 180,000 in 2023. So that gives us 270,000 rands, right? So now we've still got a cost. The cost never changes. We'll see in financial accounting too, certain replacement of parts may affect the cost, but in financial accounting one, we do not deal with that yet. So your cost is not going to change. Only your accumulated depreciation is going to accumulate, right? It's going to become bigger every year, which in turn means your carrying amount is going to come down every year. It's going to decrease every year. So if we see those figures that we've got there in the chat, the cost is still 1 million rand, and now our accumulated depreciation is 270,000 rands. That means on the 31st of December 2023, what is our carrying amount? 730. Thank you, Jodine. That is spot on. So now let us go and look at what we've typed there. It should be exactly the same. So we can see our carrying amount at the end of 22 was 910,000. We had further depreciation of 180,000 rands in the 2023 year, which then in turn means that our accumulated depreciation at the end of that 2023 year would be 270,000, which means that our carrying amount of that particular asset will be 730,000. So you can see as the depreciation from the one year to the next accumulates, your carrying amount is going to become less and less and less. So we can now, if we want to go 1 year further, we know that in the year after this, in the 24 year, in the 2024 year, we're going to depreciate it by another 180,000 rands, right? So then our accumulated depreciation will be at the end of 2024, it'll be 270,000 plus another 180,000. So that gives us what's it, 450,000 looks like. If I just calculate that quickly in my head, which means that our carrying amount will then, at the 2024 year end, will be 180,000 less than that. Now that I can't calculate in my head, but in any case, maybe let me grab the calculator again. 730,000 minus another 180,000. So our carrying amount at the end of December 2024 will be 550,000 rands, right? 550,000 because we've still got a cost of 1 million rands. Now our accumulated depreciation is standing at 450,000. In other words, the 270,000 plus the 180,000 for 2024 gives us the 450,000, and that 1 million less the 450,000 will then give us 550,000. So at the end of December 2024, our carrying amount was or will be 550. So you can see systematically we are decreasing the amount that we are carrying in our books of account, so that at the very last day that we are using that machine A, what should, or what will be its carrying amount on the very last day that we are using it? Let's see. This is a bit of a, or a kind of a trick question. Let's see if you get that principle. What will be our carrying amount right on the very last day before we are disposing of this machine, if we carry on with this depreciation method? Who wants to try take a stab at it, as they say? You can go and work it out the long way round. In other words, you can now go and add another 100 or deduct another 180,000 from your carrying amount, and then deduct another 180,000 from your carrying amount. But eventually, you'll see that at the end of the period, at the end of that 5-year term, your carrying amount will be the same as the residual value. So you have now systematically written off that 900,000 depreciable amount in such a systematic fashion that it will end up as a carrying amount of 100,000 rands at the end of the useful lifetime, because that is what your target was. That is what you believe you can sell it for. Right? You can test that if you want. Anyway, ladies and gentlemen, the trick there, in the case of the straight line method, the diminishing balance method works differently, as we'll see just now. In the case of the straight line method, the whole point is to write the depreciable amount off over the useful lifetime to its uh, to its residual value, right? So that on the very last day before you stop using that machine, it's going to have a carrying amount of 100,000 rands. Okay, now let us go and let us just pause there. Now, this is what I wanted to ask a few minutes ago. Let us pause there. Now we are done with the straight line method. Are there any questions from your side? Any questions? Doesn't seem like it. Okay. Nothing in the chat, no hands up, nobody's asking anything. Okay, so let us now progress to the diminishing balance method, ladies and gentlemen. In the case of the diminishing balance method, we also need to calculate a depreciable amount. So just like here, where in the case of the straight line method, where I ask what is the depreciable amount, and in the case of the straight line method, we brought into consideration what we refer to as the residual value. In the case of the diminishing balance method, we do not do that. We do not do that. The reason for that is that the point of the diminishing balance method is that it is going to provide for us over that period of time, which we refer to as the useful life. It is going to provide us with an ongoing estimate of the residual value at any point in time. So every time that we've calculated depreciation on the diminishing balance method, it will give us an estimate of its residual value at that point in time. In other words, let's say after 2 years, what we can sell it for according to our estimate after 2 years. If we have depreciated it for 4 years, after 4 years, it'll give us a running estimate of what our residual value should be after 4 years. So in other words, at that point in time, or what can we sell it for after 4 years? So how does this work, ladies and gentlemen? With a diminishing balance, your initial, in the very first year, and this only relates to the very first year in which you have use of that asset. Initially, in the first year, you use your initial cost. You use your initial cost. In other words, in our example, the full 1 million rands as your initial depreciable amount, right? Thereafter, every subsequent year after the first year, you use the carrying amount at the beginning of that particular financial year as your depreciable amount. I'm just going to repeat that. I know that you can listen to the recording hundreds of times, but I just want to make sure that this sinks in solidly. So, in our very first year of having that asset available for use, we are going to use the full cost of the asset as its depreciable amount. But that only applies to the first year. Every subsequent year, every year after that, we are going to use the carrying amount at the beginning, the first day of that financial year, as our depreciable amount. Now, let us put that into action. Let us see how it works. Now, in this case, like we said earlier, they will have to provide us with a percentage. They will have to provide us with a percentage, or you can work out the percentage yourself. Let's maybe just do that as an exercise. Let's do that as a small little exercise, ladies and gents. Let's say, for instance, we are using the diminishing balance method, and they've only given us the useful lifetime in years, and they didn't give us the percentage, but we now need to go and apply a percentage. How are we going to determine that percentage? Let us do a few little mental gymnastics here. Let's say, for instance, they say we are using the diminishing balance method, and our expected useful lifetime is 2 years. What is going to be your percentage depreciation per year? What is going to be, if you want to now convert that to a percentage? If they say the useful life is 2 years and they don't give you a percentage, how are you going to convert that to a percentage? You take 100, ladies and gentlemen, and you divide it by the number of years. You divide it by 2 years. 100 being obviously the full 100%, divided by 2 years. So, what will your depreciation per annum therefore be? If your useful lifetime is 2 years, 50%, right? 50%. Does that make sense? Thank you. Exactly, Mr. Zweli. 50%. Let's maybe do two or so more of them just to get this principle established. So again, let's say you are using the diminishing balance method. They only give you the number of years for the useful lifetime, not a percentage, and they say the number of years that you are going to use it for the useful lifetime is 3 years. How are you going to, or to what percentage are you going to convert that to? Same principle, ladies and gentlemen. You take 100 and you divide it by the number of years, which in this case is 3. What do you get? 33 and a third percent, right? 33. Thank you, Sisanda. Exactly. 33 and a third percent. Let's just do one more, just because this is actually quite fun. If they tell you now you are using the diminishing balance method and the useful lifetime is 4 years, 4 years, which percentage are you going to apply for depreciation each year? 25%. Thank you, Jadine. Thank you, Tamarin. Thank you, Sisanda. 25%. So you get the idea, right? Obviously, we've already seen in the case of our example where it's 5 years, it will be 20%. Anyway, so even if they don't provide you with a percentage, which they normally will if we are using the diminishing balance method, but even if they didn't, you can still convert it yourself to a percentage. Okay, so that is just what I wanted to get off my chest there. So let us now go back to the diminishing balance method. So in our very first year, ladies and gentlemen, our very first year, maybe I shouldn't display that yet. In our very first year, in other words, the 2022 year, we get to the 2022 year. Now, I'm going to ask a few silly questions now as well. We get to our 31st of December 2022, and we know that we've purchased this machine A on the 1st of July. So this is now a silly question. What is its carrying amount on the 1st of January 2022? Crazy question. It's worse than silly. It's crazy question. Sorry for that. I just want to establish this principle. What is its carrying amount on the 1st of January 2022? Nothing. Right. We didn't own it yet. Okay. So there was no carrying amount on the 1st of January 2022. So therefore, we cannot use that as a depreciable amount. So therefore, we said in the very first year of acquisition where we do not have an opening carrying amount, we do not have one whatsoever because we only purchase it during the year, then we are going to use the initial cost as our depreciable amount. So, ladies and gents, let us see whether we're on the same page. What is, in our example, what is our depreciable amount on the 31st of December 2022? What is our depreciable amount? Maybe I can just scroll up again to show it, to display it. What is our depreciable amount at the 31st of December 2022 if we are using the diminishing balance method? It is going to be equal to the cost in the very first year. So it's going to be 1 million. Thank you, Sisanda. Thank you, Subaida. Subaida, thank you, guys. Exactly. So it's going to be the full 1 million. You don't even have to have a question mark. You are spot on. Right. So it's going to be the full million. Now we know that we've got a useful lifetime of 5 years, or they could have given us the 20%, or we could have converted the 5 years to the 20%. The fact remains we are going to apply that 20% to the 1 million rands now, right? So we're going to say in that first year, the 22 financial year, 1 million rands multiplied by 20%. But then again, remember, we only had use of it for 6 months out of the year, not a full year. So we've got to go and apportion it. So that 1 million rands times 20% gives us 200,000 rands. Multiply by 6 over 12, or half of it, half of 200,000 rands, gives us 100,000 rands. Right, 100,000 rands. So now, ladies and gentlemen, we've got our depreciation as 100,000. It was our first year of depreciation, which means that our accumulated depreciation at the end of 2022 will also be 100,000 rands. So what will now be our carrying amount on the 31st of December 2022 if we are using the diminishing balance method? Thank you, Sisanda. I guess you knew what I was going to ask. 900,000, spot on. So it's the 1 million rands cost less the accumulated depreciation of 100,000 gives us 900,000. Now in year two, ladies and gentlemen, what is going to be our depreciable amount? I don't want to scroll down. I don't want to display it. In the year 2023, when we get to the 31st of December 2023, what is going to be our depreciable amount? We said now we've got an opening balance, an opening carrying amount at the beginning of the year. And our depreciable amount is going to be the carrying amount at the beginning of the year in which we calculate the depreciation. And that you've just indicated there in the chat to me, that's what we've just said, is 900,000 rands. So in the second year, which is now 2023, in 2023, we're going to use the 900,000 rands as our depreciable amount. We're going to apply the 20% depreciation rate to it. 2 times 9 is 18, so it should be 180,000 rands. And in this case, we do not apportion it, so it's for a full year. So it should be 180,000. So you can, so let us just go and display it. If I can just scroll down. So there we had it. So now the depreciation in the 2023 financial year is that 900,000 rands, the carrying amount at the beginning of the 2023 year, multiplied by 20%, that gives us 180,000 rands. That now means, ladies and gentlemen, our accumulated depreciation at the end of the 2023 year will be that 180,000 for 2023 plus the 100,000 for 2022. So that gives us a total accumulated depreciation at the end of 2023 of 280,000, right? The 100,000 plus the 180,000, which now means that our carrying amount at the end of December 2023 will be 1 million rands, still the cost, the original cost of 1 million rands, less the accumulated depreciation of 280,000, which is 720,000. Which basically means that if we should sell that machine A on the 31st of December 2023, a fair value, an expected value that we believe we can sell it for is 720,000. That's why we said initially that this almost gives us a running estimate of what our salvage value or our possible or potential sales value, which we know as the residual value, is going to be. Let's also look at the 24 year, ladies and gentlemen. In the 2024 year, when we get to the 31st of December 2024, we are going to take the carrying amount at the beginning of that 2024 year as our depreciable amount. So we're going to take that same 720,000. We're going to take that. We're going to use it as our carrying amount. We apply our depreciation rate of 20% to it, and we see that the depreciation for the 2024 year will be 144,000 rands, right? So now we can see, ladies and gentlemen, that the rate, and this is what the diminishing balance really means, the rate or the speed or the tempo, maybe I should use the word tempo. The tempo of depreciation starts fairly quickly, but then it slows down. So it started off. If that had been for a full year, if 2022 had been a full year, it would have started off at 200,000 rands depreciation. Then in the next year, it decreases to 180,000 rands. In the next year, it decreases to 144,000. So your tempo of depreciation decreases. It depreciates slower. So it starts off quickly, but it sort of puts the brakes on it, and it starts, and over time it depreciates slower, which is a very appropriate method for motor vehicles, for instance, right? Because motor vehicles lose most of their value right at the start in the first year, because immediately it's a second-hand vehicle, but then it loses value less quickly, slower, in other words, over time. So just to finish that argument, so that means that at the end of December 2024, our accumulated depreciation will be 100,000 rands plus 180,000 rands plus 144,000. So our total accumulated depreciation at the end of 2024 will be 424,000 rands. And that means our carrying amount at the end of December 2024 is 1 million rands, less the 424,000, that gives us 576,000. So again, this gives us a sort of a, like we said, an ongoing estimate of the salvage value, or what we can sell it, what it is truly worth at that point in time. So at the end of December 2024, this method provided us with an estimated selling price if we should sell it on the 31st of December 2024 of 576,000. Right, ladies and gentlemen, that is truly really the end of our lesson, but I just want to illustrate the sum of units, or the usage method as well. So I know that we are now officially at the end of our class, but I also know that you haven't got a class after this, so I've provided for an extra 10 minutes for this session. So those of you who are interested in knowing how the usage method works, you are welcome to stay behind. The rest of you, if you want to leave, I won't cry. I won't cry over that. So anyway, the usage method, ladies and gentlemen, again, we've got to go and determine what is the depreciable amount first. We've already said that the usage method doesn't use time as the basis of depreciation, but rather the capacity that the asset has, its ability to produce products for us. That is why this method is so appropriate for plant and machinery. The depreciable amount in this case is calculated in exactly the same fashion as for the straight line method. So again, you are going to estimate a residual value for you up front, and you're going to deduct it from the cost, and that is going to provide you with a depreciable amount. So the depreciable amount is, sorry, must go down further. Depreciable amount is again the cost less the residual value. Right, ladies and gentlemen, so let's again say, if we use that same example, let's say the depreciable amount is again 900,000. So our cost was 1 million rands. We believe we can sell it after or after we finished using it. I shouldn't use the term 5 years now. It depends on how we use this asset. It could be 2 years, it could be 10 years. We don't know because we haven't used it yet. And so the depreciable amount is again 900,000. Now, ladies and gentlemen, let's say our engineers, or we have employed engineers, or we might have chartered a firm of engineers to tell us what is the capacity of this machine to produce our products. And again, I'm just using round figures to make our calculations easy. You will never find these beautiful round figures in practice. But anyway, so that engineer says this machine has got the total capacity to produce 1 million units. So over its total useful lifetime, whether you use it for 1 year or whether you use it for 20 years, it doesn't matter. It all depends on how much you use it, right, in a specific year. But in totality, it has the ability or capacity to produce 1 million units. Now, let's say, ladies and gentlemen, in the first year, we used that machine to produce 100,000 units, right? In the first year we used that machine, we produced 100,000 units. So what percentage of its total capacity have we, let's use the word exhausted again, right? What percentage of its capacity have we used up in the first year? If you can type for us there, please. And I'm happy to see that most of you are still interested in this method, and not many have left. Thank you very much. 100,000 over a total capacity of 1 million. So we used up 10% of its total capacity, right? During that first year, we've used up 10%. So therefore, ladies and gentlemen, we're going to take our depreciable amount of 900,000 rands multiplied by that percentage that we've actually consumed of its total capacity, which is 10%. That gives us a depreciation expense for this year of 90,000 rands. Little trick question just to test you, ladies and gentlemen. Let's say all of that, all of those figures that we have there remain the same. But let's say we did not use that machine at all during 2022. What will be the percentage of its capacity that we've exhausted if we haven't used it at all? Tricky one. Not really. It will be 0%. 0%. So, in other words, if we did not use this, this is why we said initially that this method does not use time to determine depreciation. It actually uses its capacity together with how much you use it. So, if you haven't used it during 2020, what did we say, 2022 at all, it means you haven't used any of the capacity of 1 million. So you're not going to depreciate it at all. Or you can say you're going to depreciate it by 900,000 times 0%, which is still nothing, right? So you're not going to depreciate it at all. Now let's go so you get the idea. Let's go and look at year two. They say in year two we've produced 300,000 units. We've produced 300,000 units. So what percentage? Now this is just in this year, not in total. This is now not cumulative, right? We'll talk about cumulative in a little while. So just in the 2023 year, which is now year two is 2023. Let's say we have used 300,000 units. How many percentage points, or how much in percentage terms have we exhausted of its capacity only in 2023 in year two? 30%. Spot on. Thank you, Jodine. Thank you, Mr. Zweli. You get the idea. So in year two, 2023, we've used up a further 30%. So now in total, we've obviously used up 40% of its capacity. But when we are going to calculate just the depreciation for this 1 year, it means we are going to take our depreciable amount of what was it again? 900,000 rands. 900,000 rands multiplied by 30%. Multiplied by 30%. Right, that gives us 3 times 9 is 27, so that will be 270,000 rands. So as we can see, thank you very much, Mr. Zweli. You confirm that 270,000 rands. So that means the more you use it, the more your depreciation will be. The less you use it, the lower your depreciation for the year will be. If you don't use it at all, you're not even going to depreciate it. So there you can see, ladies and gentlemen, the time that you own or use it doesn't actually affect it, but the number of units that you are able to produce with it during the course of the year determines your depreciation percentage. Right, so after the 2 years, your accumulated depreciation will now be 270 plus 90 will be 360,000 rands, right? So at the end of that second year, and remember in this example, we didn't apportion it, but in practice, if this had been a real example, that first year would not, sorry, I'm talking nonsense. I'm talking nonsense. I take that back. Erase that completely from your minds because it's not a time-based method. You're not going to apportion it. You're not going to apportion it. So even if you bought it on the 1st of December 2022, or you bought it on the 1st of June, or the 1st of May, or the 1st of January, doesn't matter when you bought it. All that matters is how many units did you produce. So you produced 100,000 units, so your depreciation, even if you bought it on the 1st of July, will still be 90,000, not half of 90,000, the full 90,000, because you've exhausted 90,000 rands of the depreciable amount of that asset by using it during the course of that financial year. Again, in years two, ladies and gentlemen, if even if you had sold that item, let's say during the course of the year, but you have produced 300,000 units, you are still going to depreciate it with 30%, not a portion of 30%, the full 30% up till when you are going to dispose of that asset. Sorry for that little brain freeze for a few seconds there. I don't know why I brought the time in there. So, in the usage method, it doesn't matter how many months during the year you've used it. All that matters is how many units you've produced. Okay, ladies and gentlemen, that is it for today. Let us just pause there in case there are any questions from your side. So, have you got any questions? You're welcome to ask in person or to type it. I don't see anything in the chat, so I am going to assume there are no questions. Next week, Monday, we are going to carry on with the notes first, and then next week, Wednesday, I've got a question, a nice question for us, where we have to go and calculate depreciation. We have to go and record it. My original question actually only requires the ledger accounts, but we're also going to do the journal so that we have the complete flow or thread of how an accountant would record it. So we're going to look at a practical question. We might even also get to the note. I'm not sure we'll get there next week already, but uh, uh, if not, then we'll do it next week, the week after. We've still got plenty of time. Thank you for attending. Have a lovely afternoon further. Have a lovely evening. We'll speak again soon, and all of the best for Friday. I'm sure it's going to go well. Don't worry. You guys will do okay. Bye bye.